Welcome back to Street Smart, and today's big story is that August jobs report. Mark Zandi is the chief economist at Moody's Analytics, joining us now to talk about what this means for the economy and also for the White House, for Washington. Still with us is Fred Cannon of KBW, standing by at the New York Stock Exchange there with, of course, my colleague Matt Miller. Mark, first off, we've been asking a lot of economists this morning, does this tip us into a double dip scenario? What is your view?
Not necessarily. We're obviously pretty close. The economy is stalling out. But the jobs report today suggests that businesses stopped hiring. It doesn't suggest that they've started to laying off workers in a more aggressive way. And that's what would be needed for a recession. So, obviously we're on very thin ice here. But I think at this point we're not in recession, and doesn't necessarily mean that we need to go into recession.
Hey, Mark, some people have been talking about the fact that we had kind of the perfect storm in August, right? We had the debt downgrade. We had the insane volatility down here. We had the flare-up of the European banking crisis, and that sapped confidence, and it's the reason this report was so bad. Could we bounce back in September, or has the picture really just been getting steadily worse and not going to recover?
Yeah, I think that's correct. I think the economy was already weakened coming into late July and August because of the higher energy prices and the effect of the Japanese quake on the nation's manufacturing base. And then all those factors you mentioned, I think, just eviscerated confidence, and that's what we're seeing in the data. That's what we saw in the jobs data. But I do think if policymakers, the Federal Reserve, Congress, and the administration act aggressively, and they act in a very consistent and reasonable way, I think confidence should slowly repair itself and the economy should get its groove back. But that's a lot of ifs.
Hey, Mark, how do you compare the confidence numbers we got for August so far versus this job report? In line, out of line, or consistent?
I think they're pretty consistent. I mean, generally, if you look at consumer confidence and it moves as large as it did in August for 2 or 3 months in a row, that's a pretty telltale sign that you're in recession. So we've gotten 1 month, that was August. If it continues to decline like that in September and October, then it's very likely we're in recession. So hopefully August is the worst of it, confidence stabilizes, and we move forward. But we've got to watch those confidence numbers very, very carefully.
Mark, a lot of people talk about what is the Fed going to do? What are they going to do? But what about the White House? What about Washington? We've got this big critical job speech that Obama is going to be making next week. Is there anything that could actually change the jobs picture there?
Yeah, sure. I mean, I think that they have to do two things at the same time. The first thing is they've got to follow through on the debt ceiling deal. They've got to come up with more deficit reduction by the end of November, and they've got to come to terms by the end of December. They've got to do this in a way that isn't unnerving. We can't go through what we did in late July and early August again. They have to do this reasonably gracefully. And then, second thing, at the same time, is take away some of the fiscal restraint that's in train. If they don't change near-term policy, fiscal policy will subtract almost 2 percentage points from growth next year. The economy, given what we're seeing today, can't digest that. So they have to take some of that off the table by doing a number of things. Most obvious would be, for example, extend the payroll tax holiday, extend emergency UI benefits. If they did that, they would cut the fiscal restraint in half. The economy could digest it. So they need to do those two things, and I think we'll be okay.
Mark, what about the mortgage refi plan? The New York Times broke the story. People were kind of excited about it for a little bit, but it seems to have petered out, that enthusiasm. Would it, even if it doesn't bring us $84 billion in extra cash to spend, which was sort of the FHA idea in that story, would it at least boost animal spirits? Would people in this country get more psyched up?
Yeah, I think that would be helpful. I think the proposal to refinance all mortgages at 4% may be a step too far, and that there's all kinds of unintended consequences that could occur in the mortgage securities market, could drive up interest rates and be very counterproductive. But there are other things that could be done. So, for example, Fannie Mae and Freddie Mac could temporarily eliminate their loan level pricing adjustments. Those are those interest rate add-ons that they're attaching to people with lower credit scores or less equity. That would allow them to see lower rates and allow them perhaps to refinance. Now, we're not going to get millions of refinancings, but we'll get hundreds of thousands, maybe 1 million and more refinancings. And on the margin, at least, that would be helpful. And that's something that I think could be done and wouldn't cost taxpayers any money.
Mark, do you think the Fed would have to accommodate that kind of policy by buying more mortgage banks and mortgage stocks, or excuse me, mortgage-backed securities, and therefore essentially the new QE3 is really an MBS QE3?
Yeah, good question. I think if policymakers did what I just suggested, I don't think there'd be a significant backup in mortgage rates, at least not to the point where the Federal Reserve would feel the pressure to have to go in and buy more mortgage securities. But if it was the bigger refi plan, the 4% plan, where you get millions of refinancings, then I could see the mortgage rates backing up to a significant degree, and the Federal Reserve thinking, okay, well, at this point we have to engage in another round of quantitative easing that would involve mortgage security purchases. So I think that's another reason why we probably won't go down that path, because I don't think the Federal Reserve would be very interested in that. If they do another round of QE, I think they'd be much more comfortable just simply buying Treasury securities as opposed to buying mortgage securities.
Hey, Mark, we appreciate you joining us. Mark Zandi there. He is the chief economist at Moody's Analytics. He's our kind of bipartisan chief economist here because he's advised both Democrats and Republicans.